Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk.
Hmm.
Today we're looking at WETO robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Absolutely.
So imagine this scenario for a second. You wake up, you grab your coffee, and you check your investment portfolio on your phone.
Right, the usual morning routine.
Exactly. You scroll down to a stock you've been, loosely tracking, and your eyes just widen because it is up 127% in a single day.
Oh, wow, yeah. That is the dream right there.
Right. The green arrow is pointing straight up. The chart looks like a rocket ship. And for a split second, you think you found the ultimate hidden gem.
Let me guess, then you zoom out.
Yes, you pinch the screen, you zoom out to the one-year chart, and your stomach completely drops. Because despite that massive face-melting single-day surge, this exact same stock is still down 98% for the year.
Yeah, it is the ultimate financial whiplash.
It really is.
You are looking at a daily chart that looks like a lottery ticket.
Right.
But it's attached to a yearly chart that just looks like a slow-motion bankruptcy.
Which completely defies common sense until you actually look under the hood. So today we are unpacking this bizarre paradox. The company is WETO Robotics, ticker symbol WETO.
And WETO is really the perfect microcap case study right now. It is sitting at this chaotic intersection of a really flashy AI narrative and some undeniably harsh financial realities.
Yeah, before we jump into the numbers, I want to quickly bring up StockOracle. It's an AI-aided stock research platform that we use to help map out these kinds of complex wealth-building contexts.
Yeah, and there is a special 14-day trial link right down in the description below if you want to test it out.
We do want to state that it is an affiliate link, so the channel may earn a commission at no extra cost to you. Also, it is super important to remember that StockOracle provides AI insights and valuation estimates, but those can be incomplete or just wrong.
Exactly. You always have to verify important facts yourself. It is not financial advice, and it's definitely not a trading signal service or real-time market data.
Right. So looking at WETO, we need to start with the catalysts. What actually caused this pop? As of August 14th, 2026, the stock just exploded to close at $8.22.
Yeah, with an intraday high of over $10.
Which is wild. A stock does not just jump 127% on a random Tuesday for no reason.
No, not at all. And the reason here is all about the magic words of 2026, which are, you guessed it, artificial intelligence.
Of course. It is always AI lately.
WETO put out this highly polished product announcement. They launched a platform called Orchestra.
Okay, Orchestra, what is that?
They describe it as an AI hub or like an operating system for robotics. But the real hook, the thing that actually set the market on fire, was that they mentioned Orchestra utilizes NVIDIA Jetson technology.
Wait, let's pause right there. I really want to understand the mechanics of this. How does simply dropping the name NVIDIA in a press release translate to a massive spike in one trading session?
Well,
Like, are human beings really reading that release and just mashing the buy button that fast?
I mean, some of them are, sure, but the initial violent spike, that is almost entirely algorithmic.
Oh, really? Just bots?
Yeah, it's what we call the halo effect in modern trading. High-frequency trading algorithms are constantly scanning PR feeds 24/7.
Just looking for keywords.
Exactly. Words like AI, edge computing, and right now, above all, NVIDIA. Those words act like tripwires. The algorithm doesn't care about the context.
It doesn't read the balance sheet.
No, it just sees the keyword association and immediately executes massive buy orders to front-run the human traders.
Wow. So that initial bot buying creates the huge green candle on the chart.
Right. And then retail traders see the stock surging on their scanners, they read the headline about NVIDIA, and they jump in to ride the momentum.
Yeah.
It's basically a self-fulfilling prophecy driven by a buzzword.
And WETO definitely leaned hard into that narrative. In that same announcement, they talked about pursuing warehouse robotics partnerships.
They did. They estimated a potential $5 million in project-level gross profit from those ventures.
Right, but we have to make a huge distinction for you, the listener, right here. That 5 million figure is just an estimate.
Highly unconfirmed.
Exactly. We are talking about potential unsigned deals here.
And that is a crucial distinction because the physical reality of warehouse robotics is just brutal. It is not like software where you write some code and scale it globally in a week.
You actually have to build the stuff.
Yeah, robotics requires heavy capital. You have to build physical hardware, manage supply chains, provide on-site maintenance.
Not to mention the liability if a robot breaks down on factory floor.
Exactly. So claiming a potential $5 million in profit is a great vision, but until that hardware is deployed and invoiced, it's just a mirage.
Which brings us to the fundamentals, because the actual scale of WETO is jarring. You hear AI hub and warehouse robotics, and you naturally picture this sprawling tech campus.
Oh, for sure. Engineers in white coats walking around.
Yeah. But before this recent price spike, their market capitalization was cited at just $2.9 million.
It's staggering. I mean, to put that in perspective, there are individual suburban homes that cost more than this entire publicly traded company.
That is just wild to think about. They are pitching this revolutionary NVIDIA-backed system, but functionally, they are a tiny operation.
And the top-line trajectory makes that $2.9 million valuation make a lot more sense, honestly.
Right. Let's look at their revenues. With the fiscal year ending June 2025, they generated just under $5 million.
Which is actually a near 30% decline from the year before.
So they aren't just small. Their core business is actively shrinking.
Right. And it brings up a fundamental question about how markets price potential versus proof. When your company is valued at barely $3 million, a $5 million potential profit is a transformative, life-altering event.
It would literally double their annual revenue.
Exactly. So speculative buyers see that, and they price in the absolute best-case scenario. But the fundamental reality is they have no established moat, the legacy business is shrinking, and building new tech takes cash that they just do not have.
Yeah, dreams cost money, and when you look at the balance sheet, the math just completely falls apart.
It's severely distressed. Let's look at their trailing 12-month net margin, which was roughly negative 53%.
Meaning for every single dollar they managed to bring in, they are losing 53 cents.
Yes. They posted an accounting net loss of about $1.7 million. But net loss can include non-cash items. If you want to know if a company will actually survive the year, you have to look at operating cash flow.
The actual hard cash going out the door to keep the lights on.
Right. And WETO's operating cash flow was a negative $8.2 million.
Wait, hold on. If they are burning over $8 million in actual cash from operations in a year, how much money do they actually have sitting in the checking account?
Well, as of that same reporting period, they had around $1.5 million in cash and cash equivalents.
Okay, the math on that is terrifying. If you burn $8 million a year, that's what? Roughly $650,000 disappearing every single month?
Basically, yeah.
So if you only have $1.5 million in the bank, you have essentially maybe 2.5 months of life support left.
Which creates a severe going concern risk. When an auditor issues a going concern warning, they are essentially saying, mathematically, we do not see how this company survives the next 12 months without a massive cash injection.
And it's not like they are debt-free either.
Far from it. They have short-term borrowings of over $4 million. And short-term means creditors want that money soon.
Right. Now, I saw they list total assets of around $13 million, though.
They do, but remember that in robotics, assets are often highly specialized, illiquid inventory. You can't use a pile of warehouse machinery to make Friday's payroll.
Right, you need actual cash. So the ticking clock is deafening here. Which brings me back to the technicals and sentiment around that August 14th surge.
Yeah, the surge is fascinating.
If the financials are this dire, like literally weeks away from running out of cash, why did the stock jump so high? We talked about the bots, but surely the market isn't entirely blind to the bankruptcy risk.
It's not blind, but the mechanics of the stock itself heavily influence the price. WETO is a low-float stock.
For the listener who might not know, what exactly makes a stock low float, and why does that act like a powder keg?
So the float is just the number of shares actually available to trade by the general public. It excludes shares locked up by insiders.
Okay.
When a company is this small and has restructured its shares a lot, the float becomes tiny. So imagine a closed system with a very limited supply. Suddenly, the bots and day traders see the NVIDIA headline and rush in, demanding millions of shares.
But there's barely any supply to buy.
Exactly. Basic economics takes over. Demand violently overwhelms supply, and the price skyrockets vertically. It's a mechanical squeeze.
That is entirely disconnected from the actual value of the company.
100%.
Okay, that explains the sudden pop. But what about the historical illusion on the chart? Because if you look at a finance app right now, it says WETO hit a 52-week high of $251.
Oh, the chart trap.
Yeah. If I see a stock that used to be at 250 bucks and now it's trading at 8, human psychology tells me that's the ultimate bargain. I just think, well, it has to bounce back a little, right?
And that is exactly the trap that destroys novice investors. That $251 historical high is a complete optical illusion.
Wait, really?
Yeah, it never actually traded at $251 a share in real life.
Yeah.
That number is just the result of a 1-for-100 reverse stock split that happened on August 3rd, 2026.
Okay, let's explain the motivation behind that, because companies don't usually do reverse splits when things are going well.
Right. So think of the NASDAQ like an exclusive nightclub, and the bouncer at the door is strictly enforcing a rule. Your stock must trade above a minimum bid price of $1.
Or else what?
Or else the bouncer kicks you out, you get delisted. WETO's actual share price had plummeted to pennies. So to satisfy the exchange, they used a reverse split to artificially inflate the share price.
I've heard an analogy for this. It's like if a nightclub bans anyone wearing cheap sneakers. The company has 100 pairs of cheap $1 sneakers. To get past the bouncer, they just glue those 100 cheap sneakers together and declare it to be one pair of fancy $100 shoes.
That is a perfect analogy. The overall value of what you own hasn't changed a single cent. But mechanically, the price of that one new glued-together share is now 100 times higher.
And the financial algorithms retroactively adjust the historical charts to reflect that new math.
Exactly. So a stock that was actually trading at $2.51 a year ago suddenly shows up on a chart today as a historical high of $251.
It tricks people into thinking there was this massive fall from grace that can be recovered, when really it's just a reflection of brutal value destruction.
Yes. So even after this massive pop, the stock is still down about 98% over the last year.
Almost total devastation for long-term holders, and they desperately need cash to avoid dropping to zero. Which leads us to what happened on August 11th, just before the spike. WETO announced a $1.8 million private share sale.
Specifically, a Regulation S placement.
Wait, if the stock is tanking and they have a few weeks of cash left, who is buying $1.8 million in private shares? What is a Reg S placement?
Reg S is an SEC rule that lets companies raise capital quickly by selling shares to foreign investors outside the U.S. It bypasses a lot of the standard registration delays.
Okay, what's the catch?
The catch is, because these investors are taking on massive risk by buying a distressed company, they usually demand the shares at a steep discount to the market price. It's an incredibly expensive lifeline that heavily dilutes existing shareholders.
But there is a twist here, right? Because out of that $1.8 million, $450,000 came directly from their own chairman, Zheng Jiawa.
Yeah, that creates a really fascinatingly mixed signal. On one hand, you could see a chairman injecting $500,000 of his own cash as a bullish signal.
Like insider confidence, the captain steering the ship to safety.
Right. But the cynical and probably more realistic interpretation is forced survival. When you have less than a quarter of cash runway left, the chairman might just be injecting cash because literally nobody else would.
Just to keep the lights on long enough to get to the next major vote. Which brings us to the bear case and the existential risks looming over the company right now.
The ticking clock.
Yeah, August 24th, 2026. The Extraordinary General Meeting, or EGM.
They literally just did a reverse split on August 3rd. And at this upcoming EGM, they're asking shareholders to vote on another 1-for-100 reverse split.
Another one.
Yes, alongside what they're calling a massive capital increase.
Let's walk the listener through a micro-simulation of what this actually means. Say you bought 10,000 shares of this company a year ago. On August 3rd, the first split happens. They take your 10,000 shares and hand you back 100 shares.
Correct.
Now, on August 24th, if this new proposal passes, they do another split. They take your 100 shares and they leave you with exactly one single share. You went from 10,000 shares to one.
Mathematically, yes. Your slice of the pie is visually microscopic, but it gets worse because of the second part of the vote, the massive capital increase.
Right, the dilution.
Exactly. After they shrink your holding to a single share, they plan to print and issue millions of brand new shares to raise the cash they need to survive.
So my piece of the pie shrank, and then the company just baked 10 more pies and gave them to new investors.
Right.
My ownership essentially evaporates.
Precisely. And this extreme dilution risk is why the overall investment rating on WETO is a 3. It's a heavily bearish stance. The combination of back-to-back reverse splits and highly dilutive financing is just toxic to existing equity.
I have to play devil's advocate, though. Let's say I'm holding shares right now, I'm trapped. If I vote no at the EGM, they run out of cash in 2 months, go bankrupt, and my shares go to zero.
Right.
But if I vote yes, they issue a mountain of new shares, and my holdings get diluted to pennies. Is there any scenario here where the everyday investor actually wins?
The tragic reality is that at this stage in a distressed microcap, the everyday investor almost never wins. To see a true recovery, they have to thread an impossible needle.
What would that even look like?
First, the terms of that capital increase can't be overly punishing. They'd have to find an investor willing to buy new shares without demanding a massive discount.
Which is highly unlikely when they use the phrase massive capital increase.
Very unlikely. Second, that AI orchestra platform has to convert into actual recurring revenue instantly. That $5 million estimate has to become real cash on the balance sheet tomorrow.
And third,
The very next financial filing has to show a drastic reduction in that $8.2 million operating cash burn. They have to prove they can stop bleeding cash without borrowing more money.
so if we look at the final verdict, what is the long-term view here? And of course, we are not telling you to buy, sell, or hold.
No, absolutely not. But the long-term view is heavily weighed down by these realities. The recent pop was a temporary algorithmic sugar high. What is not priced into that $8 share price is the brutal reality of the EGM on the 24th.
If they issue new shares at a huge discount just to find a buyer, the stock has substantially further to fall.
Exactly. It's a battle between a futuristic AI narrative and a backward-looking historical ledger. A compelling product launch, no matter how many buzzwords it uses, does not erase a broken balance sheet overnight.
It really doesn't. Turnarounds are technically possible, but they require capital, time, and flawless execution. And right now, WETO is out of capital, out of time, and has zero margin for error.
Very true.
Which leaves us with a broader question to mull over. Think about the environment we are trading in today. When a company with less than a quarter of cash runway can see its stock surge over 120% in one day, just because an algorithm read the words NVIDIA and AI in a press release, what does that actually tell us about the market's appetite for hype over fundamentals?
It tells us the appetite is insatiable and completely disconnected from reality.
Yeah. So the next time you see a massive daily gainer flashing green, take a second. Dig into the cash flow. Check the float. Ask yourself, are you buying a sustainable business or just the algorithm's favorite buzzword? Because as we've seen, the difference can cost you 98% of your investment.
A very expensive lesson to learn.
For sure. Well, if you find our talks useful, please consider subscribe, like, and comment underneath.
And don't forget to check out that special 14-day trial link for StockOracle down in the description.
Yeah, StockOracle is a great AI-aided platform for looking into these kinds of setups. But again, their AI insights can be incomplete or wrong, so always verify the facts for yourself.
No financial advice here, just giving you the tools to research.
Exactly. Thanks for joining us, and we will see you on the next one.